Yo, what's up, guys? I just bought one of the most popular stocks in the entire world that everyone knows about, but right now this stock has a lot of hate around it, and rightfully so because of this stupid publicity move that Disney just did. Someone, unfortunately, very sadly, passed away after a nut allergy. They told the waiter, told the restaurant twice, I'm allergic to nuts and dairy, was still served dairy, and then passed away. You know, they probably trusted her. She's like, all right, I told the waiter twice, I'm allergic to nuts and dairy, so I'm just going to trust that they don't mess this up. They unfortunately messed it up and she passed away. And now this is such bad publicity. Like, I don't know why Disney would ever do this. They're like, all right, you guys can't sue, can't get any compensation because way back in 2019, your husband, so not even you, but your husband signed up for a Disney Plus free trial. And when you agreed to those terms of service, you agreed to not sue us and settle out, of course. So there's a lot of bad. I don't know what Disney's lawyers were thinking, knowing the bad publicity that was going to come with that. But anyway, let's put that aside and let's look at Disney from a pure financial point of view because that's what convinced me to buy this stock. They're actually trading at a very, very fair valuation, in my opinion, and I'll go ahead and show you that. And I actually did not buy the Disney shares in my Robinhood portfolio, which has been doing surprisingly good the past week. Is anyone else surprised that literally last week we had so much like real fears? We had recession fears, the Japan trade crap, the AI bubble, where our portfolio was under 13,000 and now we're almost at $14,000. So it's really, just a big buy the dip opportunity. And if we look, we're finally green on every single holding. We're barely green on Google though, which the DOJ said Google is an illegal monopoly. They're trying to split up Google, which I read the bull bear case on that. If they split up Google, they're worth more and they'll get a higher PE ratio when they're split up because when they're grouped together, they get a lower PE ratio. Anyway, let me go and show you this. We bought Disney here in our Moo portfolio where once I buy a stock in here, I will never sell it for the rest of my life. So yeah, I will literally never sell it. And I know you're like, you only bought 3 shares, dude. I promise you I'm going to add more over the next couple weeks. And I don't know if this rally is going to be sustained. So I didn't want to just deposit, buy all my shares right at once. I wanted to dollar cost average into the position, which statistically is better than just buying all at once, just in case if there's any crazy downturn. But also make sure you dollar cost average into good companies because look at this stock right here. We're down over $1,000 on this stock. And as you can see, each one of these buys is when I was dollar cost averaging it. And then like I was buying this sucker over $32 a share. And I was even buying it under $8 a share. Yeah, I bought the dip when there was that huge Monday dip, but that doesn't even make a difference because we were buying shares so high. But anyway, that's kind of a lesson. Make sure you dollar cost average into, probably good stocks. So now let me show you the real numbers behind Disney stock because that's what's most important. So they do pay a dividend. The yield is just under 1%, and they have a free cash flow yield of 4.91%. And what is the free cash flow yield? Basically, they make 4.91% of their entire market cap just in free cash flow every single year. And the earnings yield is the same thing, but it's net income. And actually, the net income has been artificially suppressed. So we're not actually going to look at the earnings yield right now. We'll get into that a little bit later. I'll show you how we got to look at the diluted net income. We'll get into that a little later. But anyway, I want to show you the free cash flow of this company. So look at this. They had free cash flow of $7.96 billion or a free cash flow per share of 4.38. But let's look at the market cap. So remember, they made $8 billion. We'll round up to $8 billion. So they made $8 billion in free cash flow this year, and their market cap is $165 billion. So we're going to do 165 divided by 8, simple calculation. So they're trading at 20.6 times free cash flow, which seems very reasonable to me for this huge brand, this huge name. And if we look at the forward PE ratio, it's a 17.73. That's cheaper than every other stock right now, pretty much, not financial advice. But let me show you what the analysts are expecting about this company. So we're going to go a little bit forward looking here. We're going to go out to 2028. And in 2028, the average EPS estimate is $7.73. So we're going to do a little forward looking here. So we're going to do $7.73. And I don't know what a fair PE ratio is. Like, should we do 20? So if we do 20, that means $154 stock price, just a 20x multiple on that EPS. And right now, the stock is literally $90. So that's quite a bit of upside, over 50% for sure. And I'm looking down here, it looks like they already calculated the price to free cash flow ratio, which we just did. But now we know the website is accurate. They're on a price to earnings growth ratio of 1.21, which is very fair. So let me actually now show you their diluted normalized EPS because that's the metric I actually want to look at. So when the average investor comes and does some analysis on Disney stock, they're going to look at the most popular metric, the earnings per share, and they're going to say this is a very inconsistent company. Like, look at this. Last quarter, they had negative EPS, which is terrible. I would never own a stock that has negative EPS, but this is the basic EPS. Actually, the free cash flow per share looks a bit better. It's $1.40. But anyway, this is the basic EPS. I want to show you the normalized diluted EPS, and that's this number right here. And this paints a completely different picture. They're actually the most profitable they've ever been since the pandemic. So look at this. Remember, they had some negative quarters in 2020. And look, they were making like 40 cents ever since, like 40 cents a quarter. Now look at this. In the most recent quarter, they're at $1.52. And it's only down 1% year over year because we had some tough comps. Look at that. Last year, it was up 76%. So we've actually seen some amazing year over year growth rates in their diluted normalized EPS. And on top of that, they're also doing some stock buybacks. I mean, look at this. In the two most recent quarters, or just the most recent quarter, they bought back 1.5 billion. The quarter before, they spent $1 billion. So remember, they have so much money to play with, and their total debt is $75 billion. So they could easily pay off this debt and stop the stock buybacks if they wanted to. So they're in a very financially healthy position. And Disney's dividend actually cost $550 million. So they're spending way more on stock buybacks than they are on dividends. So in the future, they'll probably raise their dividend a bunch. But also, right now, if you didn't notice, Disney actually pays not quarterly, but bi-quarterly. Am I saying like semi-annually? I'm pretty sure. All right, so now let me take you through their most recent investor presentation that came out just not too long ago, August 7th, because this company's a lot more than just the parks. They have their cruise ships, they have their royalties, the streaming service, all that. So let's go and get straight into this. So obviously we know all their popular brands. They're Disney Pixar, Cars, Frozen, Avengers. I don't need to name all these because we all know them all. Like they are a world most popular brand, and they continue to invest in their brands. Like look at this, Inside Out 2 grossed 1.5 billion and their original one did 850 million, so doing a lot better. We see Moana. This is crazy. It was the most streamed film of 2023. So this movie came out a long time ago and it was still the most streamed film of 2023 across all the platforms in the US. So across all the platforms. So no one else can take that claim because they are the number one, which is pretty crazy. And check this out. So they also have their Disney cruise ship. So this was launched in 2022. Look at this. They had the Star Wars, the World of Marvel, which is pretty cool on the Disney West cruise ship. Now there's the Disney Treasure, which is having the Haunted Mansion, the Tale of Moana, which is pretty cool. And November 2025, they're getting the Hercules, all this cool stuff, which is pretty cool. And they also have their streaming service, Hulu, ESPN, Disney Channel, National Geographic, which is pretty cool. And this is huge. Their combined streaming service actually went on an operating income. They were finally positive or break even. So look at this. Last year, they lost 550 million. Like look at how much they've just increased. So they just keep getting more and more profitable. Who knows? They may even get like super profitable with this, like Netflix does. So they may even be the next Netflix. Who knows? We see their total revenue increased 14% and the loss narrowed. So they're losing less and making more, which is a great sign to have. So yeah, they have 11-year right extension with the NBA and WNBA. And the NBA and WNBA have record-breaking viewers right now, which is pretty cool. The Stanley Cup. They have a lot of sports. They're popular in the sports industry. And ESPN had the most watched Q3 in primetime in a decade. So that's pretty crazy. And we can see that this is their experiences segment. We can see that this is growing 28%, but this is since 2019. So this isn't last year. This is since 2019, and it's up 28% and 29% on the operating income. So the operating income is just as good. It's growing the same as their total revenue, which is a great sign to see. And this is another thing. So they have 55 resorts and hotels across the world. They have 12 theme parks, 5 cruise ships, plus more in development. So they only have 5 cruise ships right now, which is actually a lot. I don't know how I like that, but yeah, they got toys. They sell little action figures of all their movies, which makes them money, which is pretty cool. In 9 games, so this company, Disney, actually spent $1.5 billion investing into Epic Games, which owns Fortnite. So Disney now owns 10% of Fortnite, and they're going to do a lot of collaborations with Fortnite. They announced that, which is pretty cool. So yeah, we can see some of their old investments starting to pay off. Their ROIC was nearly 2.5x the cost of capital. Great sign to see, very profitable. Zootopia, this is 2024 and beyond. So they're bringing back some of these cool names. But yeah, this is the Q3 results. This is kind of the end of the video. Thank you so much for watching. Don't forget to drop a like on the video. It really does help me out a lot. But yeah, look at the diluted EPS. This is from last year. So last year they had a diluted EPS loss. Now they made $1.43. Look, all these metrics are better, which is the point of this video. So yeah, thank you guys so much for watching. Don't forget to drop a like on the video. And if you leave a comment, I will respond to every single one of them. But I hope you guys have a great rest of your night.